Let's say you spent years building wealth through real estate. You've managed tenants, kept up with maintenance, weathered market cycles, and now you're ready to sell. When it comes time to cash out, you're hit with a new challenge: capital gains tax and depreciation recapture tax. Depending on how much appreciation you built, the tax bill could be in the hundreds or thousands or more. That's where the 1031 exchange comes in. It's one of the most powerful tools available to real estate investors. Done right, it lets you defer taxes, preserve your wealth, and continue growing your portfolio. But here's the truth most investors don't hear until it's too late. The 1031 exchange process is filled with strict rules, tight timelines, and hidden pitfalls. And even one small misstep, like missing the 45-day window or choosing the wrong type of replacement property, can completely derail the benefits. That's why more investors, especially those approaching retirement or seeking passive income, are turning to a lesser-known solution, the Delaware Statutory Trust, or DST. Because not only can a DST satisfy the 1031 rules, it may help you avoid the most common mistakes altogether and give you a much smoother, stress-free experience. In this video, I'm going to break down exactly how it works. Hi, if you're new here, I'm Ron Glasgow, founder of Glasgow Investment Solutions. For over 2 decades, I've helped real estate investors, business owners, and families grow, preserve, and transition their wealth with confidence. My firm specializes in 1031 exchanges, DST strategies, and tax-advantaged investment planning tailored to sophisticated investors. Let's walk through what you really need to know about 1031 exchanges, the hidden mistakes most investors make, and how DSTs can be used as a powerful tool to help you make a smoother, smarter transition. Number one is, what is a 1031 exchange and why use one? A 1031 exchange is named after Section 1031 of the Internal Revenue Code, which allows real estate investors to defer paying capital gains taxes when they sell an investment property, as long as they reinvest the proceeds into another like-kind property. In plain English, it means you can sell a property that has appreciated significantly and roll those gains into another investment without triggering a big tax bill, at least not right away. Now, why does that matter? Well, if you've owned a property for a long time, chances are it's gone up in value. If you sell it outright, you could owe tens or even hundreds of thousands of dollars in capital gains taxes, depending on your basis and your state's tax laws. That's money that could have been working for you in your next investment. This is where the 1031 exchange comes in. Instead of losing a chunk of your profit to taxes, you can defer that liability and keep your money fully invested in income-producing real estate. It's one of the most powerful tax deferral tools available to real estate investors, and when used strategically, it can help you grow wealth more efficiently over time. But, and this is the big but, 1031 exchanges come with strict rules. You only have 45 days to identify your replacement property and 180 days to close on it. The replacement has to be like-kind, and the entire process has to be executed with the help of a qualified intermediary, or QI, also known as an accommodator. It's not something you want to figure out on the fly. One misstep in the whole transaction to be disqualified, leaving you with a hefty tax bill and lost opportunity. That's why understanding both the benefits and the potential pitfalls is so critical, and it's exactly what we'll break down in the rest of this video. The most common 1031 exchange mistakes are as follows. While the 1031 exchange is a powerful tool, it's also one of the most misunderstood. In fact, many investors enter the process confident that they're making a smart move, only to find out later that a small mistake disqualified the entire transaction, creating unexpected taxes and stress. Let's walk through the most common 1031 exchange mistakes so you can recognize them in advance and avoid them entirely. Number one, missing the 45-day identification window. One of the most critical parts of the 1031 process is the identification period. You have exactly 45 days from the date you close on your relinquished property to identify potential replacement properties. That's it. Many investors say 45 days is plenty of time until the clock starts ticking. Between finding the right asset, coordinating financing, and handling due diligence, the deadline can come up fast. And if you fail to identify a replacement property within that time frame, the exchange is invalid. That means full taxes are due on the gain, even if you had every intention of reinvesting. Number two, failing to use a qualified intermediary, or QI, also known as an accommodator. Another common mistake is trying to handle the transaction personally or through a traditional real estate agent or attorney. That's not how it works. To comply with IRS rules, you must use a qualified intermediary to facilitate the exchange. The QI holds the proceeds from the sale and disperses them for the purchase of your replacement property. If the funds touch your account at any point, even temporarily, the entire exchange is disqualified. Not only is working with a QI required, it's essential to having a clean, compliant, and properly executed transaction. Number three, not understanding like-kind rule. Many investors believe like-kind means they must buy the same type of property, such as selling an apartment building and buying another apartment building. In reality, the IRS defines like-kind very broadly for real estate. As long as both properties are held for investment or business use, you could exchange raw land for a retail center, multifamily for a Delaware Statutory Trust, so on and so forth. But here's where things get tricky. The intent of the purchase matters. If you buy a new property and plan to flip it or use it personally, it may not qualify. Working with a professional ensures you're selecting properties that meet the IRS guidelines. Number four, understanding the tax impact of boot. In a 1031 exchange, any cash or non-like-kind property you receive as part of the transaction is considered boot. This portion is taxable. Boot can result from receiving cash back at closing, trading down in property value, not fully reinvesting the proceeds. Even if your intention was to defer all taxes, receiving boot, intentionally or not, can lead to unexpected tax liability. That's why your replacement property must be of equal or greater value, and all the equity and debt must be reinvested. Number five, poor timing and market pressure. Some investors enter into a 1031 exchange thinking they'll figure it out later later, only to end up rushing to find a property at the last minute. This leads to poor property selection, overpaying, or entering into deals that don't align with your long-term investment goals. If you feel like you're selling for a property just to meet the deadline, that's a red flag. Number 6, ignoring the benefits of Delaware Statutory Trusts or DSTs. This one is often overlooked. DSTs can be a powerful solution for investors facing 1031 exchange challenges, especially those struggling to find a replacement property in time, wanting passive income, or looking to simplify real estate management and retirement. A DST allows you to invest in institutional quality real estate alongside other investors, receive fractional ownership, and still qualify for 1031 exchange treatment. It's a lesser known solution, but for many it solves a number of the challenges we've just discussed. So what is a DST and why should you consider one? By now you've likely realized that successfully executing a 1031 exchange requires precision, planning, and time. But what happens when you're running out of time, struggling to find a suitable replacement property, or simply tired of managing real estate on your own? That's where a Delaware Statutory Trust or DST enters the picture. A DST is a legal trust structure that allows multiple investors to purchase fractional interest in institutional grade real estate, properties that are typically far larger and more diversified than most individuals could access on their own. Think commercial office parks, large multifamily developments, industrial logistics centers, or retail centers leased to national brands. But more importantly, DSTs are 1031 exchange eligible, which means you can sell your current investment property, defer capital gains taxes, and reinvest the proceeds into a DST as your replacement property. Let's break down why this would be a game changer for certain investors. Number 1 is passive ownership. Professional management is one of the biggest appeals of a DST, and it truly provides passive real estate ownership. When you invest in a DST, you're not the landlord. You don't collect rent, handle maintenance issues, or deal with property taxes. The properties are professionally managed by the sponsor firm with experience in overseeing complex real estate operations. For investors who are nearing retirement or simply want to enjoy life without constant phone calls, stress of being a landlord, this could be a meaningful shift. You're still investing in real estate, but without the responsibilities of direct ownership. Number 2, diversification. Without having to buy multiple properties, a typical 1031 exchange often results in trading one property for another property. That's not always ideal, especially if you're trying to reduce risk for getting exposure to different markets. DSTs allow you to invest in a fractional interest of a diversified portfolio. That might mean access to multiple properties across different regions or sectors, all in one transaction. This can help reduce concentration risk and give your real estate portfolio broader exposure without requiring millions of dollars of capital to achieve that level of diversification on your own. Number 3, easier 1031 timing compliance. One of the major pain points in a 1031 exchange is the 45-day identification window and 180-day closing window. DSTs can help solve this. Because DST offerings are prepackaged and often available on short notice, investors who are against the clock can use them to meet their identification deadlines, even as backup options if other replacement properties fall through. This flexibility can be especially helpful in hot real estate markets where properties are scarce, or if you're facing unexpected delays in financing or due diligence on a direct property. Number 4, lower minimum investment threshold. You don't need to invest millions to access institutional real estate through DSTs. In fact, many DSTs allows for minimum investments as low as $100,000, sometimes even less. That means you can split your 1031 exchange proceeds across multiple DSTs, creating even more diversification and control over your real estate exposure. For example, if you're exchanging out of a $500,000 property, you could allocate your funds across 5 different DSTs, each with unique property types or geographic focuses. Estate planning benefits. DSTs can also play a role in your estate and legacy planning. Because DST ownership is fractional and structured as personal property, not real estate, it can be easier to divide among heirs, and the income is more predictable than managing real property. It also qualifies for a step-up in cost basis upon death, which may reduce the capital gains tax burden for your beneficiaries. Plus, many investors during retirement prefer DSTs because they provide a smoother path to transition out of active management without triggering unnecessary tax consequences. Income potential. Most DSTs are designed to produce regular, consistent income, often monthly or quarterly. While these distributions aren't guaranteed, many DSTs target income in the range of 5 to 7%, depending on the asset class, market, and sponsor. This makes DSTs appealing to those who want to generate income in retirement while still maintaining tax deferral status. Of course, DSTs are the right fit for every investor. Because ownership is passive, you won't have control over the management decisions. These are liquid investments, meaning your capital may be tied up for 5 to 10 years or more, and not all DSTs are created equal. Sponsor experience, property type, market fundamentals, and fees all matter. That's why due diligence is so critical, and we're working with a knowledgeable advisor who can help you understand if a DST fits into your broader real estate and tax strategy. A 1031 exchange is one of the most effective tax deferral strategies available to real estate investors, but it comes with complexity and pressure. A DST could offer an elegant solution, potentially helping you avoid the most common 1031 pitfalls, while securing a diversified income-producing portfolio with less stress and more freedom. But every investor's goals are different, and the right strategy always depends on your unique situation. If you're considering a 1031 exchange or want to know if a DST strategy makes sense for you, I invite you to schedule a consultation using the link in the description below. We'll walk through your current property, explore your options, and help you make a confident, informed decision. Let's help you protect the wealth you've worked so hard to build and make sure your next chapter is even more rewarding.